Hey, what's going on, all? It is October 27th, Tuesday, and this is no background. This is actually in the Missouri office, so I don't have the green screen thing happening. Spencer got here on Sunday. It's been raining, storming like crazy here, which is awesome. The streams are running on the place, waterfalls are running. Went down there today to go check it all out, and it's a little bit on the chilly side, so I don't know that I was 100% ready for that. I did bring all my cooler weather gear, but not. I don't think I brought enough. But so what do we got going on in the market right now? Kind of share what show you what the rates are doing at the moment. We're seeing a little bit of kind of a merge of the markets happening here, or at least a merge of the trend lines. So I'm starting to. I was kind of wondering how things are going to work out here because we've been using the 200-day moving averages as a floor. You can see things have been kind of bouncing off of that and coming back up. And yesterday we closed below the 200-day moving average, below the 10-day moving average, and this morning opened up right below the 200 days. I'm gonna be very curious to see how that all settles out. I'm going to zoom in a little bit more, so we're right there on that line. So we've got support below us as far as the technicals are concerned, and we're right there at those two trend lines. So it's going to be interesting to see how those two merge together, and if it continues to force it downward, we stay in this channel. I'm not 100% certain what direction is that going to go. But I also know, with inflation being a worry, inflation will always have some sort of influence one direction or the other. And usually inflation is going to influence negatively with respect to bonds. And with that being the case, that negative influence could push interest rates up, but we also know that the Fed is going to continue to keep feeding it to keep it within this place, which is really kind of interesting that they're keeping it right there in that spot and not really moving around. So I'm really kind of curious what all is happening in the background. I don't have the data to go on that. So speaking of inflation, a chart that I had seen has to do with an agricultural fund that the New York Stock Exchange tracks. And if you look at this, this basically tracking commodities. Commodity expenses are really going up. So of course the cost of living with respect to your food costs, more or less, we're seeing this so-called basket of commodities here going up 13% since June. That's a big jump, 13% gain in that short window of time. So of course, showing that we have continued inflationary concerns. I've always been one who worries about inflation and where that's going to end up taking things, which could, of course, push rates to a negative position. I'll continue to say over and over and over again, I'll keep preaching that interest rates don't matter to the real estate investor. You're either in a cash flow position or you're not. I know we worry a lot about the interest rates, and that's usually been something that has been pushed on us by the marketing for your owner-occupied, very consumer mindset thought process. When you own the real estate and you're renting it out and somebody else is paying the interest and you get to deduct that on your taxes, all these things, not near as bad a situation for the real estate investor as the individual homeowner. It's either a deal that you can cash flow and continue to raise rents, or it's not. And if it's not, then that's not one you jump into, in my opinion. Of course, that's my opinion. As far as I'm concerned, the place I'm sitting in right now is a 6.99% rate. I'm cash flowing. I don't care. I've got another property here in this particular area of Missouri, 6.25. I got another one out in Alabama, 6.125. I don't care. I'm not refinancing for the rate. If I can't get cash out, I'm not going to refi. So that's my perspective on it. I'm not worried about where the rates are going as much as a real estate investor. Right now, you want to take advantage of it. They're amazing. They're awesome. There is a lot of worry what's happening with the election. The election could have some effect on it. The last election, it's thought that if Trump got elected, that the market would crash and that bonds would spike, therefore dropping interest rates significantly. So if you watch that night as the election was going on and people were tallying the votes and you started to see that Trump was getting ahead in the electoral college, you started to see the stock market started taking a beating. I think it's close to 1,100 points, if I remember correctly. I was in Memphis that day that was going on. But he was losing, or at least we were losing that kind of ground in the stocks. We're thinking, well, tomorrow morning is going to be a phenomenal day for locking on rates. The day opened up, the market opened, and the market gained back everything it lost and then some, and the mortgage-backed securities dropped significantly way before they opened up, started issuing rates. So interest rates spiked. I mean, half a point to a point that within a day or two. So we saw a massive change. Here's my thought on this. We're going into an election. A lot of people are stressing about what that's going to have. it's hard to say what we're going to get out of this, what we're going to end up experience if we do end up having a second term with Trump as president. I think it's going to be status quo with what we're already having. Hard to say what's going to happen if we end up with a Biden presidency. The thing that really frustrates me is, why are we even having the good discussion? You know, regardless of who the hell gets elected, they should be doing what's the best for the country, not for their own personal damned agenda. And why we're even worrying about this means that there's some stuff going on that shouldn't be happening. They should just be doing what's best for the United States and the people within its borders, period. And the fact that we have to stress about who's sitting in there and how it's going to affect the market frustrates the hell out of me. I'm not going to spend a lot of time on the soapbox on that one. I would love to. I'd love to just spout off about all the stupidity that we're dealing with there. In fact, instead of a soapbox, I'd walk around and platform freaking shoes and stand there and preach about this crap. But we can't do that. We got to focus on what we got in front of us. Right now, for you as a real estate investor, focus on the fact that what you purchase has to cash flow and has to be something you can raise rents on. You get those two things, you know, and of course you got a great, as long as you got a great team, you know, whoever you're working with on the property management side, the acquisition side, then on the lending side, you can be confident you're going to continue to do well with your real estate investments. Leverage high, leverage long, pay off slow, as we had indicated. Again, leverage high, you know, up to 20% down. So you're leveraging 80%. Leverage long, 30-year fixed. Pay it off slow. Don't accelerate that payment. Pay it off in the time it takes. Also, go back to the website, aaron.chapman.com. Scroll down. We're continuing to collect for Operation Underground Railroad, continue to keep driving those funds towards those guys and help those out there who are out there trying to take these rings down. We need to do something about this human trafficking crap. It needs to stop. Thanks, guys. We'll talk to you on Friday.